Japan just hit another record high. The Nikkei is sitting at 69,404. And every retail trader is piling in, thinking this is the start of a new leg higher. But here's the problem. The 200-week moving average is at 55,278. That's a 20% gap. And the last time we saw this kind of extreme, the index corrected 15% in 7 weeks. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today. Here's the verdict on the Nikkei 225. Trending strongly bullish on every time frame from weekly down to 1 hour. All 5 time frames are in strong buy territory. But here's where it gets interesting. The ADX is at 40.7, which tells us the trend is extremely strong. But the CCI is at 142.5 and Williams percent R is at -0.989. That is textbook overbought. So the bias is trending, but we are in the late stage of the trend. This is a fading opportunity if you have the conviction. Write this number down, 70,460. If we break above 70,460 with a daily close, the entire structure resets and we are looking at 71,520 and then 73,359. But if we reject at 70,460 and break back below 68,621, the structure flips to corrective. Right now, the herd is overwhelmingly long. Institutional positioning shows record net long exposure. The retail crowd is chasing at all-time highs. That's the setup that creates the trap. Let's start from the weekly chart. The Nikkei is trading at 69,404, far above the 200-week moving average of 55,278. That's a 26% premium. The 50-week MA at 63,194, the 100-week at 59,928, they're all pointing straight up. Price action has been relentless. But look at the MACD on the weekly. Momentum is still positive, but the histogram is starting to flatten. The divergence between price making new highs and MACD losing steam, that's your first warning. Drop down to the daily chart. This is where the story gets really interesting. We closed at 69,404, and the daily trend is strong buy, but the RSI is at 67.07. Not overbought yet, but getting there. The daily MACD reading is 1,392, a massive number that shows the trend is still intact. But look at the distance between price and the MA20 at 65,922 to 4.3% above the 20-day average. That's a stretched condition. The MA60 at 63,194, MA100 at 59,928, all below, all supportive. But here's what most traders miss. When the Nikkei is this far above the 20-day MA, we typically see a mean reversion to the MA20 within the next 5 to 8 sessions. Now let's drill into the 4-hour chart. This is where the trap is being set. We have a clear ascending channel from the March lows. The upper boundary is exactly around that 70,460 level. The lower boundary is at roughly 68,000. We are currently sitting at the top of the channel. And the 4-hour MACD? It's showing a negative divergence. Price is making higher highs, but momentum is making lower highs. That's a classic reversal signal. The stock is at 94.8, extremely overbought on this time frame. The 1-hour chart confirms the exhaustion. We are seeing compressed candles, wicks to the upside, and rejection from the 69,500 level. The 1-hour MA20 is at 69,078. We are currently above it, but barely. If we close below 69,078 on the 1 hour, that's your first sign that the buying pressure is evaporating. Key support levels: S1 at 67,561, S2 at 65,722, S3 at 64,662. Resistance: R1 at 70,460, R2 at 71,520, R3 at 73,359. Pivot point at 68,621. This pivot is crucial because it represents the average of yesterday's range. If we break below pivot, expect a flush to support. Now watch the cross-asset linkage. The US dollar to Japanese yen is hovering around 157. A weaker yen fuels the Nikkei because exporters benefit. But the BOJ is starting to signal discomfort. Every 100 yen move higher in US dollar to Japanese yen adds approximately 200 points to the Nikkei. That's the relationship that matters. If the BOJ intervenes and strengthens the yen by 3%, the Nikkei could drop 2,000 points in a single session. Here's what most traders miss. The Nikkei's correlation with the S&P 500 futures is 0.72 over the last 30 days. But when the S&P is also making record highs, the correlation breaks down during pullbacks. The Nikkei overreacts to downside. So if we see any risk-off move in US markets tonight, the Nikkei will gap down aggressively tomorrow. Let's connect the fundamentals to the price action. Yesterday's Japan stock market close saw the Nikkei up 0.21%, another record high. The driver is simple. The Bank of Japan is sticking to its dovish script. Governor Ueda's speech last week explicitly stated that the central bank will maintain accommodative policy until inflation is sustainably at 2%. That means no rate hikes anytime soon. But here's the twist. The headline number doesn't tell the full story. The Nikkei's rally is being driven by three sectors: technology exporters, trading houses, and financials. And each one has its own fundamental driver. The exporters are benefiting from the weak yen. The trading houses are benefiting from commodities. The financials are benefiting from the yield curve steepening. But all three are dependent on global risk appetite, not just BOJ policy. The US dollar to Japanese yen outlook is the single biggest variable. If the BOJ intervenes, it could force a 2,000-point correction. We saw this play out in the summer of 2024. Intervention at 160, Nikkei dropped 2,500 points in 3 days. The market has not priced in the intervention risk at all. The options market is showing implied volatility at 15%. Which is actually below the 6-month average of 18%. That tells me the market is complacent. Geopolitical risk is another factor. China's economic data has been weaker than expected, and the Nikkei is the China proxy in Asia. If China disappoints on GDP next month, the Nikkei will feel the pain. And then there's oil, the geopolitical heartbeat. If crude spikes to $90 due to Middle East tensions, global inflation fears resurface, and the Nikkei, as the most exposed export-driven market, will sell off harder than the S&P. So what's the 1 to 2 week directional lean? I'm neutral to bearish at this level. The probability of a retracement to 67,561 is higher than the probability of a breakout above 70,460. The event that invalidates this view is a daily close above 70,460. That would force a reassessment and likely trigger a chase higher. Do you think the Nikkei breaks 71,500 this month? Comment yes or no. I'm tracking consensus. Most people skip this section. That's exactly where the money is made. Keep watching. Strategy 1. The sniper, conservative. This is the high probability setup for traders who want to sleep at night. The trigger condition is a rejection from the 70,460 level on the 4-hour chart. Specifically, I want to see a 4-hour candle close below 70,000 after testing 70,460. That's the confirmation that resistance is holding. This strategy is about catching the pullback with a defined, limited risk. The entry is at 69,850, but only after we see that rejection candle. I want to close below 69,900 on the 4-hour to confirm selling pressure. The stop loss goes above the rejection high at 70,650, which is about 800 points above the entry, 1.1% risk. This is tight but gives the trade enough room to breathe. Target 1 is 68,100, which is the first support level where buyers will step in. That's a 1,750-point move for an 800-point risk. Risk-reward ratio of approximately 2.2 to 1. Target 2 is 67,561, the S1 level. If we hit that, We are looking at a 2,289-point move for a risk-reward ratio of 2.86 to 1. The setup is voided entirely if we get a 4-hour close above 70,460. That would be a breakout and we'd need to reassess the structure. The sniper, conservative, entry, 69,850, for H close below 69,900 after testing 70,460, stop loss, 70,650 take profit 1, 68, 100 take profit 2, 67,561 risk, reward, 1:2.9 hour invalidation, void if 4H candle closes above 70 for 60 strategy 2, the active trader, standard. This is the pullback to moving average play that statistically works in strong trends. The condition is a dip to the 20-day moving average at 65,922. This is a classic mean reversion strategy for trending markets. When a market is as overextended as the Nikkei, a pullback to the MA20 is the highest probability long entry. The entry condition is price touching the 65,922 level on the daily chart with a bullish reversal candle. A hammer or bullish engulfing pattern confirms the entry. The stop loss goes below the recent swing low at 64,500, which is 1,422 points below entry. That's 2.1% risk. Target 1 is 68,500, the mid-range of the recent channel. That's a 2,578-point move for a 1,422-point risk. Risk-reward ratio of 1.8 to 1. Target 2 is the previous high at 70,000, which would be a retest of record territory. That's a 4,078-point move for a risk-reward ratio of 2.87 to 1. Once target 1 is hit, I trail my stop to break even and let the trade run to target 2. Type your Nikkei 225 range for tomorrow in the comments now. Let's see who's aligned. The active trader, standard, entry, 65,922, daily touch plus bullish. Reversal candle confirmation, stop loss, 64,500 take profit 1, 68,500 take profit 2, 70,000 risk, reward, 1:2.9 hour invalidation, void if daily close below 64,500 strategy 3, the aggressor, high risk. This is the countertrend fade the breakout play. The condition is a false breakout above 70,460. If we see price spike above 70,460 and then immediately reverse and close back below 70,000 within the same 4-hour session, that's the trigger. The entry is at 69,900 on the retracement back into the range. The stop loss goes at 70,660, just above the potential spike high. That's a 760-point risk. Target 1 is 68,621, the pivot level. That's a 1,279-point move for a 760-point risk. Risk-reward ratio of 1.68 to 1. Target 2 is 67,561, the major support level. That's a 2,339-point move for a risk-reward ratio of 3.08 to 1. This is a high-risk, high-reward countertrend fade. Only for those who can lose small and manage risk aggressively. If you are not comfortable with 2% risk in a single session, this is not the trade for you. And watch for the invalidation. If we close above 70,660 on the 4-hour, the breakout is real and you get out immediately. The aggressor, high risk, entry, 69,900, on false breakout rejection below 70,000, stop loss, 70,660 take profit 1, 68,621 take profit 2, 67,561 risk, reward, 1:3.1 hour invalidation, void if 4H closes above 70,660. Never risk more than 1 to 2% per trade. No positions through high-impact news. If the BOJ intervenes tomorrow, it doesn't matter what your analysis says, you need to be out. Stops are non-negotiable. This is how you survive to trade the next big move. Position sizing is the difference between professionals and retail. Assume each trade could be wrong. If you can't handle the risk, don't take the trade. So here's your takeaway for the Nikkei 225. The single most critical level for the next session is 70,460. If we reject, Expect a move towards 68,621 and possibly 67,561. If we break, the next technical target becomes 71,520. Tomorrow's focus is the Japanese economic calendar. PPI data out at 7:50 p.m. Eastern tonight. That will set the stage for the BOJ's next move. We are also watching the US dollar to Japanese yen at 157. If that breaks 158, the intervention risk spikes. If you want the full breakdown on Bitcoin and the Nikkei divergence, that video is live now. Tap the end screen, smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.